Hello, everybody. My name is Wade Comeaux, and I have an esteemed guest today, Stephen Curtis from NRL, and we also have Jeff Johnson. Derek is having a little bit of a technical difficulty today, so he is not going to be able to attend, but I will guide us through the beginning of the presentation. Very excited today. We recently made a large transition, as did Stephen Curtis. We're going to talk a little bit about NRL. Stephen has an exciting new role, very exciting new opportunity for him and his group, an exciting opportunity for the Catalyst Group and the Catalyst Group at NRL. So very excited about that. We'll deep dive all of those things, as well as giving you the normal market update and our opinions on what's going on in Texas real estate. So really looking forward to it. Stephen, thanks for joining us today.
Thanks for having me, Wade. Very excited to be on here today, and also we're very excited to have you guys as a partner.
Absolutely. So give a little background to Stephen. Stephen and I first started working together, I don't know, maybe 25-ish years ago at this point. It's been a really long friendship and business relationship, and Stephen is one of the best out there, one of the top producers in his branch, and he has recently accepted a position as Chief Production Officer with NRL. That's a company he worked for in the past. He had moved on for a few different reasons, but always maintained a great relationship with them. And Stephen, tell us a little bit about your move and the exciting things you're working on.
Yeah, so thank you, Wade. So I had spent from 2010 to 2016 at NRL Mortgage, and I love the people here. I was running a branch with a couple other people, and we just had differing opinions on what was next for us. So I wanted a clean break, always liked the people at NRL, kept in touch with them forever. Spent most of my time away at Fairway, where I served as a senior vice president, and we grew our team from 30 million year one to $500 million was our biggest year. And that year I also did just under 50 million in loans personally, while managing a region and keeping my work hours around 45. So very much lean on systems and very direct and concise communication, and very trusting in my team. And I think some of that and learning in that growth is what got the opportunity for me to return home to NRL and serve as the Chief Production Officer. So I can take what I learned over those years and try to give it to everybody for free. That's the point we are in the career, Wade, where, at this point, we're a resource for everyone else to try to watch everybody else grow. So I'm very excited about it. It's been a great 5 or 6 months. And we got a lot of exciting things coming. So appreciate that.
No worries. I will say a couple things about recruiting in general. We are definitely looking for loan officers in San Antonio, Houston, and Dallas that are passionate about real estate investing, being a trusted advisor, and a person who can offer a wide variety of products specifically for real estate investors. But I know, Stephen, you and your team are also recruiting very broadly for people who are focused in the owner-occupied space and working with real estate agents. Tell everybody a little bit about that.
Yeah, so we've been looking at, what is the historically in the recruiting strategy, right? And it's, you try to find a branch manager that's got a group, you try to bring them in, because companies are not built really to support a singular loan officer. So what we're doing is a little bit of a different strategy. We've created a model where we want a singular loan officer that's doing 500,000 to 2.5 million. And we've built out an internal support structure for that person to where if they don't want to pay for the layers of management on the owner occupied side, right? Because over time, that's what's built your margin. We have a support system internally that they can dial into, and most of the time have a more aggressive pricing structure, which obviously you've been able to see. And sometimes even with their expense load, just depending on what it is, have same or better comp too. So if you can make the same money with better rates, right now rate is what everybody cares about in the owner occupied market. A few years ago, if you were within a quarter, that was fine. Now people will leave you for 300 bucks. So we have to be aggressive, and we feel like we've created a strategy that's been attractive to people, and we've been very successful recruiting to it.
Yeah, I think that's a great model, and I think it works very well in kind of correlation with what we do. We provide leads and a lot of mentorship and avenues to find business in this space. You're really looking for people who have a book of business already, are deeply experienced, and don't need as much guidance from a manager, and I think that works really well for your group as well. So they really kind of blend together, and that's why we think it's such a great partnership. So it's a good combination.
I agree.
The one thing I'll say is, whether you're a loan officer looking for a job or you're a potential borrower, it hasn't been very long, but in the short period we've worked with Steve's group on the operations side, they are outstanding, like very efficient. They get loans pushed through the system quickly. They communicate at a very high level, so everyone knows what's going on. So if you're a loan officer, that's obviously a great value to you, and for borrower as well, right? We want you to have a good experience. So the team over there that Steven's put together does a great job of pushing loans through as quickly as possible.
I will also add, if you don't mind, Wade is holding me extremely accountable to making sure that they are in the top 25% in pricing always. And if they are not, then we make corrections to make sure that happens. So very important.
Yeah, absolutely. One of the big reasons we moved to NRL is we saw an opportunity for improvement in price. We really pride ourselves on being a one-stop shop to real estate investors, providing those hard money loans, as well as providing takeout strategies with DSCR loans, which are no doc loans for real estate investors, as well as conventional loans. And candidly, we were struggling to get the price that our people deserve. Steven mentioned it earlier. It's a highly competitive environment. We were having a big challenge with getting some of those refis done on the backside. And now with two key things, Steven and his team have given us outstanding pricing. I'm actually going to let Jeff cover a few highlights in that area in just a moment. And then also, we have a price match guarantee as well, which is it's not something that we have to use very often because our price is so strong. But in an instance where a borrower thinks they can get a superior price, we've been able to use that, and we're very passionate about it. We believe, to Steven's point, that if you can be efficient and be systems oriented and not just have to have enormous amounts of staff and other things that are very expensive, we can offer best in class service and best in class price to people. And I'm super excited. My entire team's super excited about that being a big part of our value proposition to people. And I'm just excited to be with a group that's that passionate and dedicated to providing. So it's been great. Jeff, you want to cover a couple pricing highlights real quick before we dive in?
Sure. So we always look at three things. We look at owner occupied rate term or purchase. Investment property refis, obviously that's what we focus on in our space, is hard money and investment properties. And then also DSCR. So just briefly running over some of the highlights on an owner occupied rate. I saw one down 6.75 and no points. You can get 6.5 around a point. And you can get lower than that if you're willing to pay a little bit more in upfront fees, if maybe you're looking at a longer time frame. As far as investment property refis, again, somewhere in the high sixes, I would say 6.875 with 1.5 points is where we're seeing pricing. You can get down to only 0.5 point at 7.25, so very reasonable rates. And then the one I was most excited about is for folks that do DSCR loans. So these are people that maybe have run out of conventional loans, or maybe they don't qualify for income purposes of self-employed. Maybe they write off a lot of stuff. We have DSCR pricing at par in the 7s. So, which is outstanding. I was really excited about that. High 7s par pricing, that means no points. A lot of times when people talk about doing hard money to refi, they're paying a couple points on all transactions, right? We have the ability to price deals at the high 7s and no points. You can go all the way down to 7 if you're willing to pay some points. But I was very pumped to see a no point option on the DSCR loan through NRL.
Yeah. Hey, Jeff, real quick, just to give you a little bit of context there, today the national average for owner-occupied 30-year fixed is 7.29.
Yeah.
So to be anywhere near that on a DSCR loan with minimal cost, especially if you're a real estate investor, you're retaining the equity that you're putting into your hold. Huge win.
Yeah, that's within a point, and going from a owner-occupied conforming to a DSCR loan, that's not much difference at all, and a huge difference in risk and how it used to be priced out. Nice job. That's great.
Couple other quick points on that. With NRL, we do have some no prepayment penalty options, and that is a very exciting opportunity for real estate investors. most of us do believe, while not maybe in the immediate future, that there is going to be rate relief in the future. So having a no prepayment penalty option is very exciting. There, of course, there is an increase to price, but a lot of investors feel that's a worthwhile opportunity. And then the other big thing is turn time. These products we're talking about, most of them are going to be internally underwritten. So we can literally get to a clear to close in about 72 hours from a complete package. I can tell you, we've been brokering a lot of these products over the years, and that may be a 15 to 30-day process from the time we submit a complete file whenever we're brokering those loans. From a real estate investor, why that matters so much is, one, you're staying in that hard money loan longer at a very high interest rate. And then two, we're also locking these loans. A lot of the people that we broker with did not have a locking mechanism. And in times of tumultuous, economic situations, for example, at the beginning of COVID, and whenever rates really went up a couple years back, people just got stuck with massive rate changes at the last moment. So the fact that we can get these deals locked and close very quickly with outstanding pricing and better customer service, everything internally underwritten, this is a massive change for us that we're really, really excited about. All right. No more talk about that. I'm going to give a quick disclaimer that we're just talking about our opinions. No one should be making investment decisions based exclusively on this information, and that you need to do your own due diligence. And then next, we're going to dive in we talked a little bit about our value proposition. If it's okay, we'll move past that slide. And then we will dive into what's going on in Houston. And Stephen, I know you're based in Houston. You know this market incredibly well. Tell us what you're seeing in the numbers and also just what you're feeling, what's going on in the market.
Yeah, what we're seeing is increased inventory. That's what we're seeing. We're starting to see the inventory increase. When you look at year over year, we're seeing more active listings. We're starting to see the amount of time that they're on market is not necessarily going up, but we are getting more homes coming on the market. So, we do see a lot of inventory come from new construction, but we are feeling that the resale market is starting to give up a little bit of that inventory that was so tight last year. And a lot of that we're seeing when we do a deep dive on the data, it's just affordability. A lot of people, even, buying in the last 2 years, even if you caught it on the upswing, maybe you have a 4.5, maybe you have a 5% rate. Insurance is up 38% year over year, 2 years in a row. Taxes have been up. So there's some people that are experiencing affordability issues, even in their 4% rate. And we're starting to get some of that inventory leak into the market.
Yeah, I think we're seeing that too. I listened to some national pundits talking about this, but I think what's happening, not only with us, but in other areas, is that they're starting to get an acceptance of rates. A lot of people that need to move for a reason, or they need to upgrade their home to a larger home because they're having children or an expansion of the family, maybe bringing in an elderly parent or something like that. People, they're like, well, I'm going to give up my 3% today, or my 3.5%, but I'm also going to give it up in a year or two because I don't see rates coming down that much. And I need to make choices that are based on my life as it sits today. And I think people are just getting where they are recognizing that. And are they happy about giving up that great rate? Not completely, but you have to make sacrifices sometimes to have the lifestyle that you want or that you need. And people are starting to do that. So I agree with you. We're going to look at a chart a little bit later, which shows the percentage of homes on the market that are new construction, but we are seeing a little bit of that resale market soften as well, which is good. Anything in the stats you see here, Jeff, jumping out?
No, I always kind of come back to focus on what we do. And what we do is we help people build wealth. And I know a lot of folks are sitting on the sideline the last couple of years with rates being higher, worried about cash flow. And we're going to get to rents later, but the bottom line is the deals we've been seeing for the last year are still really, really good for investors. The amount of money you're spending out of pocket relative to how it was during COVID, it's not even close. It's still way less money out of pocket, and the values are still going up, right? Like they went up 3-4% this last year. Over the last 5 years, you held on the property, it's up 38 to 40%. So, and with, like you said, rates eventually will go down. You can refinance. It's a good time to buy when your cash out of pocket is so low. Like you said, you get to keep that equity. You're stacking up 25% equity on these deals with little out of pocket. And the market doesn't really make much difference. You're going to get good deals. So I think it's a call to keep buying investment properties.
Yeah, I'll make one other quick comment on that before we move on. I hear a lot of less savvy, less experienced, less educated investors talking exclusively about cash flows, right? Cash flows are down. There's no question about that. Average cash flow, maybe it was 450, 400 a couple years ago when rates are lower. Now it's maybe 200, maybe even 175, 150, something like that. But that's a very unsophisticated evaluation because it does not bake in what your money out of pocket is in a transaction. ROI is the number to talk about, return on investment. If you're out of pocket half as much money, you're getting half as much cash flow. That's actually a really good scenario for you because you own two properties. You distribute your risk, and at the end of the rainbow, you own two properties worth probably $1 million with the way things go, over 30 years appreciation, maybe even more, instead of just owning one. So in the overall scheme of things, I would take all day long, lower out of pocket, lower cash flow, and two properties than just having one where I had to really pay up because everybody wants them so bad because rates are low. And then the other thing to think about is you can never change your purchase price, but you can change your interest rate eventually. I'm not saying it's going to happen in 6 months. I'm not saying it's going to necessarily happen in a year, but there will come a time when interest rates are lower and your cash flow will go up. You're never going to change that money out of pocket. If you're out of pocket 50K, that's going to be there forever. Right now, people are more likely out of pocket 25K, maybe 30K. So ROI is key. Stephen?
I mean, yeah, no, I said, yeah, we're gonna look at it later. I just realized it's right there. Like if you look at a property you bought in 2019 versus now, your rents are up, what is that? $500 almost? It's $100 a year. So we talk about it all the time. As things turn over, your rents go up. They outpace property taxes and in tax and insurance. Even in a high raising insurance and tax environment, I don't think it's kind of $500 a month. So like you're winning right there. It's right there on the sheet. $500 for the last 5 years. That's exactly what we've been talking about.
Yeah, Stephen, I think you might have had a comment too. Anything to add to
Yeah,
that?
well, I was just going to say that, I also do buy and sell real estate as well. And I recently completed one flip. I have one on the market. And what I will say is, depending on what you're trying to do, you can win either way right now. And if you're doing whole and you're willing to take a lower cash flow, in my opinion, if your goal is to build wealth through investing in real estate, you would want rates to stay higher longer. Because right now you can buy more homes while everybody else is sitting on the sidelines. If you're willing to accept a lower cash flow, when rates come down, not only does your cash flow increase, but so does your accumulated equity. Because your property value is going to go significantly higher than 4% in that year that rates do go down to a more palatable number. So you really got to look at it both ways.
For sure. Great. We might be getting a little background noise on your speaker there, Stephen. I don't know if there's something you might be able to do, but I think I may hear a little something.
Go ahead.
Yeah. Nonetheless, let's go on to Dallas next, please. And in my opinion, Dallas is without question, the highest appreciation market out of the 4 major metros. Incredible success story. It is slowing down a bit. Houston is actually catching up on some of the year-over-year numbers, which you can see. But as far as the long-term numbers, the numbers are just astounding. The average sales price going up from pre-COVID 60%, median sales price up 56%. Those are amazing numbers that none of the other major markets in Texas can really compete with. But overall, the home sales are up from the previous year, down from a pre-COVID stabilized market type number. Total volume's way up. Active listings is a little bit down from pre-COVID. And then you see that average sales price, which is way up there. You're talking an average sales price of $515, median sales price of $413. And that does make it challenging to get rentals there. We often talk about it. If you're going to be in the central part of DFW, that can be a challenge. But what investors are really doing is going farther out. And Catalyst supports that. We lend farther out. People are getting fantastic deals in areas where you can commute to the McKinneys or the Fort Worths or areas like that. And it may be a 30, 45-minute drive, but you're still able to get to major job opportunities for your real estate investments. Those tenants can get to a job where they can make $100,000 a year or 75,000 and really pay those rents. So we find that investors are doing very well as long as they're willing to go a little bit further out in Dallas. Anything to add to that, Jeff or Stephen?
Yeah, I mean, like you said, it's just like Houston, only slightly different, right? The year over year is a little smaller because they had such a big run up, but if you look at it over the last 5 years, it's significantly higher. The lease, just to keep harping back to this, you know, the leases are up. Is that $900 roughly over the last 5 years? I mean, that is a massive jump between 2019 and today. Same house is going for $900 higher 5 years ago. I mean, your payment's flat, not including your taxes and insurance. Your payment's flat. So every year you're stacking almost $200 a month on these renewals. So it just tells me it's like I said, keep buying rental properties. It's hard to lose if you give yourself enough time.
Yeah, that is literally double what the increase has been in Houston. There's probably two ways to look at that. One is Dallas has been on an incredible run, but I think that also makes me think when we look at the end at the affordability index, the income in Houston is not drastically lower than Dallas. So I would think there's a lot of room to run up on Houston rents, and that the market will eventually correct itself, in my opinion. It should have more upside there. I think Dallas, there have been so many jobs moving there, especially white collar, higher income jobs with a lot of corporate headquarters moving there, that there's a lot of pressure, upward pressure on rents, but I think that will normalize and Houston will start to catch up. That's just a guess.
Next slide.
Jeff, you want to start with this one?
Sure. So San Antonio, it's sort of similar to the other markets, but there's also a little bit of differences. You know, if you look at the total active listings, that's way up, you know, up 33%, which is just like the other ones. The average price is up smaller. The median is actually down. So as you guys can see, relative to Houston and Dallas, they had modest median gains year over year. San Antonio had a modest loss. So I do think the market is not as great as the other two. And also the months of inventory going up, that's normal, right? Houston and Dallas went up slightly in both cases, but the days on market has also gone up. That is not the case in Houston and Dallas. Houston and Dallas days on market fell what, 7 days in Houston, fell 5 days in Dallas. This actually went up 7 days. So I do think you're seeing a slowing in San Antonio. That said, lower prices, like we always talk about, lower prices, your dollar can stretch a little further. And I do think for some reason there's some opportunity in San Antonio that's not quite being taken advantage of yet, because I do think it's a really strong rental market. And we talked previously in other webinars about how certain publications predict San Antonio is one of the best investor markets in the country. So I do think San Antonio has some upside there, but you know, based on these numbers, it's a little bit weaker than the first two markets.
And what's really interesting, we don't have a presentation on this month, but in many previous months, we found national prognosticators who rated San Antonio like one of the top 1, 2, or 3 markets in the entire country for home price appreciation in the future. That's happened several times. So while these numbers, if you're just looking at them in isolation, are definitely not the strongest of the 4 markets, I do believe there's a lot of other reasons about future job opportunities, the discounted price relative to other markets in Texas and across the country, the amount of amenities that are in San Antonio with that lower price point. They give a lot of reasons to think, while the story may not be as positive in the short run in San Antonio, I think there's a lot of positivity over a longer tail. All right, Austin. So Austin is an interesting story as well. You look at that pre-COVID median sales price, it's the second highest, not nearly as high as Dallas, but right in line, slightly above Houston. So still a good appreciation story there. But the the days on months of inventory and the days on market, not unlike San Antonio, are definitely significantly higher than Houston and Dallas. So that market had just an enormous run up. There was so much price increase, so much demand. And then I think that market, had the pendulums often overcorrect. I think we're in that overcorrection at the moment. And then, this area may come back a little bit faster eventually. I don't know exactly when that's going to be, but Austin and San Antonio, whenever you look at the national prognosticators, they tend to say those two markets have the highest upside, even above Houston and Dallas, because they've corrected a little bit more. But definitely in the short run, you have more months of inventory, more days on market. So those areas may be a little bit tougher to flip a home in, but I think there's a lot of upside on buy and holds. And Austin's the same story as Dallas. You're definitely going to have to go further outside of the downtown core metro area in order to find good rentals, but they can be found. Stephen, I know you have locations in greater San Antonio and Austin, right? Don't you have some people out there?
Yeah,
How are
we
things
have
going?
Georgetown area and South Austin. Yes.
Okay.
So what we're seeing is we've had a big uptick in the north of $800,000 price range. We're seeing actually those move quicker for whatever reason. The days on market are quicker on those than you're seeing. Like, there's not a lot of inventory in Austin in general. I mean, 10,800 is not a lot with 3161 in pending sales. But what we're seeing is just the base price for new construction and resale is just really, really high. That they're pushing the conventional loan limit a lot. So we're getting a lot of people that are getting into non-conforming loans. And so that's been a little bit of a challenge, but the inventory is still moving quickly. The days on market is still quick, even with the huge appreciation in price, right? With the average, I think this is, I think maybe Dallas was a little higher on median sales price, but where Austin is a little different is they have two subsections of market really. We have kind of the 400 to 600, and then they have the 900, 800, 900 plus. And that's really where the builders build too, is in those two subsections. And what's interesting is the 800, 900 plus, the dirt builds, they're spoken for and deposits and done before they finish them. So it's really interesting. So that's what we're seeing on the retail owner occupied side.
Yeah. Interesting. Well, that tells you maybe my estimation of flips being somewhat challenging there may not be true, because if there's a limited amount of new construction inventory, it might be a really good time for flippers to get in there if there's that much demand for properties, right, that are well done. There may be less, maybe some of that slowness is maybe on properties that are not pristine, but a flip can be pristine as well, not unlike new construction, obviously.
Yeah, I would say the Round Rock area has some opportunity that has the Tesla campus in it, and it has a lot of homes that were built in the 60s and 70s. So there might be some opportunity there if you can get some of the older ranch style homes and redo them. If you can get them at a good price, I think you could probably create some inventory in an area that's really growing.
Yeah, that's a good point.
Yeah, not to cheat a little bit ahead, I looked at the income over to the affordability index, and the Austin income has just blown up over the last 5 years. Like, all those jobs that came in, it's so I think there's a baseline level of support there where, folks are making good money. It's never going to get too low. The other thing I want to talk about in San Antonio, just as a reminder for investors, if you're doing rehab jobs in San Antonio, there is a thing called the task force. So, and they are aggressively making sure that any and all rehabs had permits pulled, and they are aggressively red tagging projects if you did not and you get caught. So I highly recommend everybody going through the permitting process. It's a couple $1,000 and it's maybe a little bit extra time and a pain in the butt, but there's nothing worse than getting red tagged or having stuff come after you've done a lot of work, right? That means you got to open up walls possibly and redo stuff. It gets way more expensive. So for San Antonio investors, I just want to throw a reminder out there that they are aggressively looking for projects, and make sure you get your permits.
Yeah, And you can't dodge it. Like, it's not just like you can avoid the people that are driving through and looking for work going on. I mean, that's what Houston, Dallas, and Austin investors do. Like, you drop off the dumpster on a Friday afternoon, clear it over the weekend, pick it up Monday morning. Nobody's the wiser. They're looking for MLS listings for rentals and for flips. And if they see those, then they're coming in and saying, looking at the work you did. So it's a very different scenario. One other thing I do want to mention is I think that while some San Antonio investors are a little bit sour on what they're doing there, I think it was a necessary evil because there were a lot of contractors doing bad things, and they're really tightening that up. I believe they're requiring some licensing now in the greater San Antonio area so that they can expel the people who were bad actors. There were some people that stole deposits and other things up front. So I think that this is something that needed to happen there, and that it's going to produce better results for investors over time. It is a little bit of a pain in the butt to get these permits, but if $1,000 helps you avoid losing 15 or 20,000 bucks or more, then I think that's a win-win overall.
Sure.
Next slide, please. So this is days on market for the major metros. And obviously, the COVID era was unprecedented in the past decade. But if you look at it, the days on market at this point are a little bit above kind of where we were in that 2016 to 2019 era, but not unlike where we were in 2011 to 2014. And just a reminder for everyone, a normal market for inventory is about 6 months, right? So we're still well below those numbers overall. Anything in particular jumping out here, Steve?
Well, not particularly, but something I wanted to just bring to light in the partnership that Catalyst has with NRL Mortgage. If you are doing flips in this market and holding costs matter, rates, borrowing costs are high. So in an effort to give you another option to maybe make your listing a little bit more presentable, we do have an option for you to pre-lock in a below market interest rate for your flip, so that when you go to market, you can market it with, let's just say a 599 government loan or something like that. And what we found is when we go to listing agents and sellers and they do this strategy, right now it's kind of like shooting in the dark. You want to get an offer and then you want to get them in, and then you start really kind of negotiating on all fronts. Is it price? Is it cost? What are we doing? And what they found is this gives them an opportunity to budget in what they're willing to negotiate, offer it in terms of rate, because that's everybody's hot button right now. And when they come to the table to make an offer, they make it very clear, like, listen, it comes with this rate. We've prepaid for that. That's the negotiation. So if you like the home and you like the rate, that's it. Just know that up front. This is the negotiation. And it's been extremely good leverage for them.
Wow, that's a cool approach. I like that.
Yeah.
All right, next slide here. Jeff, do you want to run with this one?
Yeah, I'm having a hard time seeing, so I'm going to try and blow this up. So, and this is kind of what we were talking about yesterday. The housing supply, while historically low, hit a 4-year high in April as homes lingered on market. And this is kind of what we were talking about yesterday, Steve. This is a national number, right? In Texas, things are still very solid, like we talked about. And this can be overcome if you have a flip on the market or you have a property on the market. Like Steven said, if you talk to him about this, what was the program called again, Steven? I can't remember the name of it.
It's just called List and Lock.
List and Lock. Yes. The List and Lock program can help somebody that's got a property lingering, talk to us about this, and we can get it over to somebody in Steven's team and walk through the strategy. And then you kind of told me the numbers. I know it's pretty new, Steven, but with the number of people you've had some pretty good success, right?
Yeah. So the very first week that we launched it, we did 12 in the first 48 hours. And that only gave us 2 days to kind of get ready for that first weekend. Every single one of these properties were on the market 30 days plus when we did it. 25% of them went under contract that weekend.
Wow.
The rest of them we're about to go into the second weekend coming up. So we're going to get better statistics, but so far, 1 out of 4 aged inventory homes that are going out and advertising a below market interest rate are going into contract within the first week.
Man, that tells you how big of a driver
Rate.
that interest rate is in the opinion of buyers. Like, it's just a huge driver, right? That's amazing.
Yeah, and think about it like this, right? If your flip is priced at, let's just say it's 300, right? As a buyer, think about you. I mean, we all talk about money all the time. Would you rather spend 310 for a home at 599 or 300 for a home at 75? I'll pay 310 all day long. So it's a strategy that as an investor, maybe on the NRL side, we can help you with, so that when you're figuring out what to price and how to be aggressive in trying to keep your holding time down, it's something that Catalyst can offer through their partnership with us that could be a difference maker for you.
Well, that's really good. That's really cool. Well, definitely, if anybody has questions on that, reach out to us. And Stephen's contact information will also be provided at the end of the presentation. So one last thing I want to mention here before we move on is, a lot of people perceive the housing market to be in really bad shape back in 2009, which it was. I'm not saying it wasn't. Stephen and I, Jeff, everybody was a part of the great financial crisis that was driven in large part by the real estate market. But you look at that average price back then, 208, right? This is 15 years ago. What are we at today? 420, basically double. So what that tells me is that's a huge amount of increase in a very short time frame. Literally, the average home in America is basically doubled in price in, what is that? 15 years. And it's not just home price appreciation. That's a big driver. Whenever you're a real estate investor, you've got home price appreciation. You have monthly cash flow. You have monthly cash flow. You have the ability to depreciate expenses, right? You have so many different things that make a big difference as a real estate investor. So it's not just this number, which is very compelling. There's also other things that make a big difference as well. All right. Next slide.
You got it? Wait.
Sure, I can cover this one.
Oh, okay.
No worries. 1/3 of the houses for sale are newly built. So this is a very powerful thing to consider for flippers, right? Why is this such a compelling number? It's because there's very limited inventory out there, because most people, while they're getting more willing to give up their very low rate, there's still not that many people willing to give up their very low rate. So it's a lot of new construction. So if you are a person looking at doing new construction or looking at flipping properties, these numbers are very attractive because it tells you that for the foreseeable future, there's going to be a limited amount of inventory, and that your flip property is going to be very attractive to people because there's just not that much out there. Like I know we looked earlier in while the inventory is up year over year, it's still not up to pre-COVID, right? Year over year, last year inventories were historically low. They're still, very low. Whenever we say a big increase in inventory over the last 4 years, I don't know that that's extremely relevant, because the last 4 years were an unprecedented mortgage market because of COVID. You really have to look to that pre-COVID number. So whenever we see that headline, while it's relevant, you really have to compare to a normalized market. You can't really compare to the middle of COVID. So I think if you're looking at being a flipper, it's a very positive number. Also, whenever you look at the new permits and the new construction building optimism that's out there, being a home flipper or being a spec home builder, it is a very good time because of the lack of inventory. You guys have anything to add to that?
No, I mean, this is what we're seeing in every market, Wade. And I'll also say that if you are going to be building new construction, Catalyst, through their partnership with NRL, also has the ability to do forward commitments where you can lock a bulk of money at a predetermined below market interest rate on the homes that you're building, so that when they are done, you can market those rates and compete with some of the larger builders that are doing the same strategy. So that's something that you have access to through the partnership with Catalyst.
Oh, that's great. Great info.
Yeah.
All right, let's go to the next slide. Jeff, do you want to run with this
Yep.
one?
So this is kind of what we were talking about earlier. If you go back to 2012, this is Texas comparing new and existing homes. You can see in 2012 as a baseline, they stayed pretty flat for those 4 years, right? New construction and existing. And then starting in 16 or 17, it started creeping up a little bit on the new construction side. And then it's just gone through the roof relatively for the last couple of years, right? You see that gap. It was massive starting in 2021, and it is, I think, the biggest it's been ever right now. So it's just kind of more what we've been talking about, how people just don't, I know it's getting better, but you know, people don't want to leave their existing rates. And so the new construction market's picking up that slack.
And if you're a real estate investor, I don't think better is the right word. You would love to continue to see this. Why do you want more inventory? Like this is a win-win if you're a flipper. You'll take people not selling their existing properties all day long. Are you really competing against, in large part, our new construction homes? That's a win. So there's a lot of different ways to look at pricing and also interest rates. And I think savvy people look at the positives, and there's a way to make money in any environment. And right now, flippers that are really good, if they're putting out a quality product, they're to Stephen's point, he's done a couple recently. Like it is a market in which there's not as much competition. It's a supply demand factor, and it's really good. So if I were a flipper, I would love to see that there's not a lot of competition out there. That's just a win for me as a flipper.
Yeah.
Next slide, please.
So you look at the next slide, it kind of tells the exact same thing. You look at the number of new listings over the last, year? I mean, it hasn't been that low since 2012. Like, there's just not much hitting the market right now. So to your point, if you have good stuff, it's great.
Yeah, I mean, that's why context is so important. That headline said, all 4-year high on inventory. Sounds kind of bad. But then you look at this chart where it shows anything other than the most unusual housing market probably in U.S. history. And then, it's way below anything that happened since 2012. So still not too much inventory to cause any type of problems in the market for sure. Anything to add to that, Stephen or Jeff, before we move on?
No, I mean, again, same. I'll just piggyback on what you're saying. Headlines are not always reality. Just because it says 4-year high of new inventory, that doesn't mean there's a lot of inventory.
Yeah.
There's tons of opportunity in the space that we're speaking about right now to make money on holds and flips. Tons of opportunity.
Yep. Well, one of my favorite quotes is lies, damn lies, and statistics, right? You gotta really look behind the numbers to understand what they mean. I want to turn this next slide over to Stephen. Stephen is fantastic at talking about interest rates and what is driving them. So Stephen, what are you seeing not only with how interest rates are currently built, but where they go in the future and what could impact mortgage rates going forward?
Yeah, we have a couple things that we're looking at. So, Fed funds effective rate, it does start to affect long-term rates once you start to get into the range we're in now. So everyone's looking for when is that dip going to happen. If you look at the relationship that we had from 2010 to now, very rarely did the funds effective rate exceed the treasury, right? It happened in 19, which is when we started to see a little bit of a run up, which was pre-COVID. And to be honest, without COVID, likely we would have had a mild recession. So COVID kind of maybe gave us a bailout on that. And then we see it now in the run up because obviously inflation was not transitory, it was real, and we were behind the ball. So now we're trying to bring that down. So what we're seeing is the most recent forecast. So today we saw a little bit of maybe wobbling in the job market. The Fed has a dual mandate, right? So if they don't see PCE inflation at under 2%, but the job market starts to take a hit, they will lower rates. So we're looking at both of those things. We got a big report coming out with PCE inflation tomorrow. I am getting wind that it is going to be a favorable report for interest rates. Today we had a little, GDP was low for the forecast versus what actually landed today. And then the unemployment or the initial jobless claims was higher than expected. So all the correct levers are going our way right this moment. We had a little bit of a sell-off earlier this week because anytime anyone from the Fed speaks, we're knee-jerk right now. So if they say, hey, cuts may not happen this year, or cuts may not happen until November, we see a sell-off. There was a below average expectation of the bond auction that happened on Tuesday, caused a huge sell-off in MBS. However, when we start to see the triggers that the Fed is paying attention to show weakness, that is when we start to see the pickup. So we're starting to get some of that back. I still think we're going to finish this year in the 6s on owner-occupied rates. I think that we will get, whether you want to believe it or not, there's geopolitical things happening. It is an election year. They do have a tendency to try to balance things out if they can. So if we start to see a little bit of weakness in the job market, I could see them pushing that first rate cut. Right now they're saying October, November. Would not surprise me if they threw it in September, just to have time for that to percolate throughout the political cycle. So I would say September for that first rate cut. So everything that you're doing between now and September, you've got people that are not in the game with you. And we're telling people the exact same thing on the owner-occupied side. If you want to wait until rates go down, you're going to be met with maybe a little bit more inventory, but a lot more people that are going to come out of the gates and buy. There was actually an article that came out that said for every 1% rates go down, 5 million more people are qualified to buy an owner-occupied property.
Wow.
So
Yep.
If you think there's a lot of competition now, wait until rates go down.
Yeah, that's true. I tend to agree with you. I think that there'll be a rate reduction before the election, and a couple big reasons for that. One is, interest rates going down usually causes a relatively quick increase in the stock market. Stock market goes up. That's a very quick impact. Mortgage rates come down. That's a quick impact. What's a slow impact is to inflation, right? Inflation, that does not impact things nearly as quickly. So there'll be time to avoid the inflation numbers going up before the election happens. So I tend to think September is a very good guess in my opinion.
Yeah, that's a powerful number, 1% for 5 million. I mean, that's going to bring a lot of competition. So if you are on the sideline thinking about, maybe I should wait, yeah, you'll get better terms because you're going to have a lot more people trying to buy the exact same house you are.
Jeff, just to give you some context, there's not 5 million homes for sale.
Yeah. Not nearly. Yep. All right, we got a few more slides we need to get through. We're getting close, but we have a few more before we get to the end. This one quickly, housing starts up 5.7%. And you see here, this includes multifamily in the blue line, only single family in the red line. And the multifamily starts are down a little bit. You can see that gap in between the red and blue line has narrowed. So that tells you more single family starts, fewer multifamily starts. The gap was a lot larger for a while. I think that the multifamily area was more confident in that 2023 period, but you can see that there is a lot more optimism in the single family space, and that number is definitely going up. So that's what I take from that. I don't know if you guys take anything else from that slide.
No, I think that's right.
Okay. Next slide. And Jeff, do you want to walk us through this housing starts versus population?
Sure. This is just, we hit this every time, just to kind of like Stephen just did, give a little context. This slide is a measure of housing starts going all the way back to, say, the late 50s. That's the blue line, and the orange line going up and to the right is population. So, if you start at, call it 2005, 2006, if you look at the number of housing starts between that point and now, compared historically to previous decades, we are building, or we have been building, significantly less houses for the past 15 to 20 years than we did in almost any decade, right? But look at the population. It's growing significantly. So that is, part of the reason why we have this inventory shortage. We're just not building enough houses. And we have too many people, relatively speaking.
Yep. And that is not a speedboat that can be turned on a dime. That is a very large boat that takes an eternity to turn. So it's going to be that way for a while. Flippers can get homes on the market really quickly. So that is a good opportunity. Rental vacancy rate on the next slide. One thing that I think is very important here is the last time vacancies were this low is whenever rates were also higher than usual. Definitely, we're not in an 18% environment at this moment, but we are higher than we've been in some time. And that squeezes potential buyers. They can't afford as much. It pushes them into that rental market, which means rent rates go up, vacancy goes down, all big wins for real estate investors. So in times of increased interest rates, if you want to know how it's going to impact you as a real estate investor, a buy and hold real estate investor, a landlord, you can look to other times of significantly increased rates. That period from 79 to the early and mid 80s was a period of incredibly low rental vacancy rates and big increases in rental rates. So that is only a positive indicator for you as a landlord or a potential future landlord. Stephen, I'll let you cover this one because you're really good at discussing rates and the affordability index. If we can go to the next slide. What do you see in this chart? Very interesting chart.
Yeah, so this is kind of what we talked about a little bit earlier when I made the comment that for every 1% that rates go down, another 5 million people are qualified. The affordability, we have several things working against affordability, right? We have low inventory, which keeps upward price pressure on the available homes that do go on the market. We have high inflation, which has caused us to have higher interest rates. And then we also have, like I said, nationally, the last 2 years in a row, we've had a 38% increase in insurance costs. And then most taxing entities in the state of Texas have had a significant increase. And I believe they did it on purpose because they knew that the new homestead law was coming out. So I think they tried to get in front of that so they wouldn't have lost revenues. And I think that we've had a lot of people that when you put all those together, it's just kind of a perfect storm of really, really difficult time with affordability. So when you start to be the person that offers that 599 rate or the builder that offers a 5.25 pre-disclosed rate, you're bringing into the market a buyer that thinks they are out of the market. So it is a strategy to open up your property to people that otherwise would not be able to buy a home.
No doubt. Yeah, that chart has had a lot of movement over time.
It looks, yeah, there's a lot going on there.
All right, let's go to the next slide, which is the affordability index. And there's a couple things that are interesting to me. And we like to cover pre-COVID, May 2019, May 2023, and May 2024. Arguably the most interesting thing to me is, and we talked about this a little bit earlier, you can say, San Antonio has a little bit more days on market, some other things like that. But if you look at this, how affordable is San Antonio? So compared to Dallas back in 2019, 42%, Austin 39%, and Houston 38%, all in a tight band. The share of income for a mortgage payment. San Antonio was down at 30%. You go to May 2023, San Antonio at 31%, Austin 43, Dallas 41, Houston 37. You come to current, Austin 53, Dallas 52, Houston 47. Look at San Antonio, 36.81. So while there are some things like more inventory, longer days on market, and other things that are not the greatest indicator for San Antonio, I think the reason the national prognosticators are so high on San Antonio is that there are a lot of high quality jobs moving into that area, and it is immensely affordable. They have a lot of amenities, good restaurants, good entertainment, other things like that. Maybe not as robust as as some of the other major metros, but compared in affordability, that is significantly more affordable. And it's not as if the income levels are drastically lower. You look at the average income in San Antonio, it's like not even $1,000 less than Houston, right? So I think we do quite a few buy and hold deals there in San Antonio, and I think there's a lot of reasons to think that market can support significant upward price increases and significant upward rent increases. Whenever we look at the rents, it's a similar story. San Antonio rents are significantly less than Houston, despite the income level being comparable. So a lot of upside there because of that.
Yeah, I know Steven's got a hard stop, so I'll just be brief on this. So I think it's, I try to find like a like number, and it just represents, honestly, like how much more expensive it is to have a mortgage payment these days, because I think it was, oh gosh, Garland, 69, well, there we go, 63. Garland is 31, but if you look at in 2023, Garland is 63, and that's at 31%. Fort Worth is 38%. So like the same place, 63rd place, is up 7 or 8%, right? And I bet if you go back to the previous chart, it's roughly the same, right? Corpus is 28%. So each 4 years difference and 1 year difference, that number keeps growing significantly. So, these high rates obviously put a damper on this number. But there's so many markets in Houston that are still rent friendly, right? They haven't priced themselves out, right? They aren't New York or even Austin, for that example, where you just can't buy a rental property. A lot of these Texas markets are still rent friendly.
Yep, absolutely. Well, I know Stephen has a hard stop. I, in large part, do as well. I know we normally do a few questions, but I think we're right up against the time. So, Jeff, unless you have anything else to add, we can go to our last slide and give everybody a way to contact both us and Stephen. Can we go to that last slide, please? Stephen, well, I see your information there, Stephen. I don't know if there's a way directly to reach you there. How would you like people to reach out to you and your team?
We can use email. I can type that into the chat right now for everyone.
And you also, if you also don't mind giving it verbally, I'm not sure how that shows up on the recording.
I have it sent to, yeah, it's only going to send to you guys. So it is Steven with a V, STEVEN .Curtis, CURTIS at nrlmortgage.com. Steven.Curtis at nrlmortgage.com.
Absolutely. Really appreciate it, Stephen. Good luck in your new role. I know you're already crushing it, and we're happy to be a part of the group. And thank you very much, Jeff and Derek. Great job putting the information together today. Everybody, thanks for joining. And have a great one.
Appreciate it, gentlemen.
A second, I want to tell you guys the winner of the drawing is Kevin Wright. So congratulations, Kevin Wright. We'll reach out to you and go from there. But thanks, everybody. Y'all have a good one.
Thank you. Have a great day.